Hello everybody and welcome. My name is Hannah Gooch-Peters. I am a global investment analyst of the Global High Quality team based in London. We're here today to talk to you about our $1.5 billion global high quality strategy. I'm here with the fund manager, Pieter Fourie, and we're going to take you through our presentation today. Thank you very much for listening to us and welcome to everybody. We understand we've got quite a wide audience from all over the place, so it's fantastic to have you listening to us today. You've got the presentations in front of you. We've got, like I said, just shy of $1.5 billion under management now from our team. Our team was built 7 years ago by Pieter in 2012 when he joined Sanlam. And we're really delighted. We've won a number of awards, high-profile awards actually, for our strategy and also for various members of our team, including myself. I was named, very luckily, the Young Investment Woman of the Year in the UK last year. And Pieter here was named the FE Alpha Manager, which is actually the top 10% of fund managers across their track records and across all asset classes in the UK. So it's a wonderful accolade to have. We've also won a number of awards for our risk-adjusted performance, the Investors' Choice Awards, and also Private Asset Managers Awards as well. Our strategy consists of two main ways to access it. That's either via institutional funds, and that's what we're going to talk about today, the Global High Quality Fund, which is $550 million, and also via segregated mandates. But the beauty of it is it's very scalable because no matter how you access us, it will still be run in exactly the same way, to the same global high quality investment philosophy employed by Pieter across his 11-year track record and across the period of his career so far. So what are we trying to achieve? We're a long-only global equity fund. We do bottom-up stock picking, and we have a global universe to select high-quality businesses from all around the world. We have a team of analysts sat in London. We'll take you through the team later. But we're all generalists, and we do all of our idea generation ourselves through quantitative screening. And also we utilize external research as well to complement our research, complement our ideas, to challenge our own analysis. Our research is all bottom up. We use discount cash flow methods, and then we write qualitative research as well. And it's a fantastic team. Like I said, we're all generalists, and it means that we can all challenge each other's ideas and assumptions. So, for example, we'll have Pieter here will cover British American tobacco, and Louis on our team, another one of our analysts who's been with us for over 5 years now, will cover Altria. So we can really challenge each other there, just like Louis will also cover Edward Life Sciences, which works a lot in heart valve replacement technology, and William will cover Medtronic. So that's also a fantastic way that we manage to source ideas from each other's research there.
Yeah, thank you, Hannah. I mean, we obviously travel quite extensively globally to meet with our investors and the invested companies that we own. A good example would be William, who's just been on a 2-week trip to San Francisco, California, to meet with some of our companies like Microsoft to make sure that the vision that they have for long-term growth is still valid today, and then be comfortable with our fairly large exposure there, which we've owned for over a decade. I've also had the chance back in May to meet with many of our invested companies, including Sabre, Medtronic, the likes of Yum China and Yum Brands as well. These are businesses that we've owned in some cases for over a decade, and we really continue to be impressed by the way that management execute their strategy and just the quality of the businesses that we own, which is really core to what we do. Buy great businesses, keep them for the long term, make sure we don't overpay, and have an active overlay where we can select from our quite focused universe of companies to make sure we select only those companies that have a real economic moat that can last for hopefully a few decades, and buy those companies at fair value and let the quality of the businesses compound the returns for us as it's happened over the last 11 years.
So if we have a look at the next slide on our investment process, you're now wondering if we've got a global universe, which is fantastic because it means we can go anywhere in the world for our ideas. How do we cover this? Well, the short answer is we don't. So we use a screening method to screen that down from the 2,700 companies roughly in the universe down to a watch list of 120 stocks. Now, these 120 stocks embody our criteria that we're looking for to invest in our portfolio. And these are all analysed by our analysts, they're researched, they've got models, and they are a source of our best ideas. But we like a concentrated portfolio, and our portfolio for us typically is between 25 to 35 names. It's 30 names currently. And so what we do is when we look at a company, and this 120 names may or may not be in value. So we determine through our research what we would like to pay for it. Like Peter said, valuation is a core of what we do. And so through our discount cash flow modelling, we will derive an intrinsic value for that business. And then we're looking for a margin of safety from where it's currently trading at. To be able to order and invest in it. And ultimately it's Peter through that risk reward trade-off that will determine the position size and whether or not it enters into our portfolio. And so we have our portfolio of 30 names, and like we always say, if you've got 99 names in the portfolio, how well do you know number 99? But every single name in our portfolio we know inside out, back to front, and so nothing's going to keep us awake at night.
Thank you, Hannah. So for those of you that have the presentation in front of you, just what are those criteria that we're looking for? And some of the main criteria on page number 8 for the presentation in front of you, hopefully. We are interested in high free cash flow conversion. We have an example later on of a company that we've been building up a position over the last few weeks, Intercontinental. It really encapsulates a lot of the attributes, if not all of the attributes we're looking for in our businesses. They are very well positioned. They've got large economies of scale with their hotel operation that they have. It's a franchise model, so that's how they maintain 43% return on capital, because they don't build any of the hotels themselves. It's fully franchised. Furthermore, their capital expenditure is very low at $150 million a year. It's only a fraction of their revenue, so it's very capital light. They have a very solid growth profile of 3 to 4% in real terms above both the travel industry as a whole, as well as the general gross domestic product growth worldwide. So they have a secular growth advantage and very much also a very strong balance sheet, often pays a special dividend due to their excess cash flows. And as we say, from a valuation point of view, our main criteria is high returns on capital and attractive free cash flow yield. If we look at the business in our time horizon of 3.5 to 5 years, that free cash flow yield on average about 6.5%. So very, very compelling, both in the context of our universe as well as obviously other asset classes, which at this stage looks quite stretched to us. So with that, of course, come the volatility of the earnings stream itself, but that's where long-term investing is important. And we typically, as I say, would like to keep our businesses forever and just let those returns compound for us. In terms of dynamic capital allocation, again, Intercontinental, Johnson & Johnson, they are great examples of businesses that will divest. Medtronic did the same recently. They will divest from areas of lower return on capital and deploy that capital in areas of higher growth or higher return on capital and maintain what is ultimately a 28% return on equity portfolio for us, which we still think in this environment is very, very compelling for a long-term investor. From a portfolio construction point of view, on page number 9, as Hannah alluded to, we typically have a focused portfolio. We've always had between 20 and 35 names over the last 11 years, but we don't take extremely active positions on a singular stock level. In terms of our risk control for portfolio construction, in terms of some of the awards we've won, certainly the Investor's Choice Award focused on downside protection, on things like Sortino ratio, and also our absolute drawdown when the market gets big dislocations. But Hannah will take you through some of those processes where she does, as the investment analyst, detailed work on the portfolio itself to make sure that we don't take undue risks in the portfolio. Ultimately, we believe the lower risk profile of the fund is a function of our bottom-up stock selection, which focuses on companies that ultimately have a lower earnings volatility profile than what the market in general has, and that way we are not ashamed to disregard 95% of the universe altogether, just focus on those businesses that we believe will adhere to the risk profile that we're looking for. In terms of valuation, I think Hannah's going to take you through our MasterCard example and our journey that we've had over the last 5.5 years in this name.
So MasterCard is an example of a fantastic company that we initiated on back in 2013. It's our senior equity analyst, William Ball, that covers that name. And it's a great business. And like I said before, we've got a long-term time horizon, 3.5 to 5 years, but ultimately we're investing in fantastic businesses that we want to hold forever. But we won't hold and we won't keep them at any price, and valuation is core to what we do. So when we look at MasterCard, we initiated back on 2013, and you can look at your chart there. Across the period that we held it, we actually experienced a 345% dollar return. But when do we sell our businesses? And a hard sell criteria for us is if a company goes below 4% free cash flow yield 2 years forward. And when we looked at this business back in September last year, it had dipped below that. It had gone to 3.7%, which hit our hard sell criteria. So we took it out of the portfolio after a fantastic experience for our investors. But what's really good is that when we take something out of the portfolio on valuation grounds, it just goes back into our 120 stock watch list, and it's a company that we would like to really own again in the future if it comes back into that margin of intrinsic value.
Yes, so we are ultimately value investors. We would like to own our businesses forever, but if you look at slide number 11, we give you a few examples of companies that we have owned for over a decade, and that includes the likes of Microsoft, Diageo, Johnson & Johnson, and Unilever, and certainly they've produced stellar returns for us over that period. Our assessment on value for some of these companies have changed, as you would expect. They have become quite popular within the wider investor community, and we believe they will continue to, of course, exhibit returns exceeding that of the market simply because they have very entrenched positions in areas of secular growth. But none of them features a top 10 at the moment. We have cut down those position sizes simply because they've become more expensive, but we still want to own these businesses for the long term. Yum Brands being a good example as well. On the second column, in terms of our active overlay, certainly Samsung we've owned from time to time, depending on our assessment of value. Today we do own the stock. It's very interesting. It is our top performer this month in what is turning out to be quite a tough month. So from our perspective, that 14% free cash flow yield is very attractive, even though they have some corporate governance issues in the short term. On the flip side, this year and during the course of the last year, we have sold great businesses like Edward Life Science. Hannah mentioned the transaortic valve replacement therapy that their sole focus is on, but it's trading on over 35 times earnings, and we've had a great outcome for our investors, but we feel it's a little bit too expensive today. So we have exposure to medical equipment through names like Johnson & Johnson, partly because that's part of one of their core divisions, and a pure play in the form of Medtronic. It's really performed very well for us this year. Other names that we've sold, Yum China on the attribution side, 53% return this year, quite volatile from time to time, and we believe the stock's worth about $44 per share, currently at 45. So we are just, again, it's in our universe of stocks we'd like to own at the right price, and we still have some indirect exposure through Yum that gets a royalty stream of 3% per annum of the revenue of Yum China, so we still have some exposure there. On the right-hand side, if we move towards the column of names we'd like to own, there's a huge slug of businesses, including Accenture, Intertech, diverse industries that they operate in. And we have those lists, and we keenly observe and keep analyzing those businesses to see if we can get big opportunity in them. Even though Nestlé is a terrific business, we just think at 3.5% free cash flow yield, it's perhaps not as valuable for an investor to own today, but we obviously await a chance to re-enter these positions if they come back into value. On the right-hand side, in terms of our core positions, Facebook, Sage, Allergan, and Sabre have been positions that we've added over the last year. They've been significant contributors to performance. At one stage, Facebook was up 50% for the year, and at $203, we did reduce that position size, and today it's down to about 3.5%. The regulatory concerns are flaring up again this month. That is the sort of news flow that we will perhaps use to increase that position again for us. From our perspective, those names like Facebook and Google actually trade at very attractive levels versus many European consumer staple stocks in particular, even though we don't deny that the news flow from a regulatory point of view is quite adverse at the moment. That is the sort of opportunity that we wait for in order to build a position in great businesses. We're just going to take you through the next bit of the presentation, which will actually cover performance. So Hannah's going to talk to you about the fund performance since inception.
So how is all this translated for our investors? And you can see here, so this is from the inception of the Global High Quality Fund back in 2014. Now these are annualized numbers in US dollars. And we're very, very pleased to see that, our investors have had a fantastic experience, compounding 8.9% a year versus 6.6 for the world market, and then just over 4% for our peer group, which is the IA Global. It incorporates all global equity funds. And for us, our 5-year time horizon is really important. And these numbers put us in the top 5% of all global funds. What I personally find very interesting is the fact that over 1 year the market is actually flat. It's like just over 0% over 1 year in dollars. And so we're also very pleased that whilst, for us, our longer term time horizon is what's important, to be able to also outperform over those short periods as well is very pleasing for us.
Okay, so on page number 40, we also have our long-term track record. That's very important because one could argue that sort of all managers have done reasonably well over the last 5 to 10 years, given that it's been a big bull market. What is very good for us is that 10% compound US dollar return over the last 10 years, again, ahead of the market, a strategy which typically perhaps doesn't perform as well as the market from very low areas of valuation like we had in March 2009. But even through a full-blown bull market, we've managed to outperform in the last 5.5 years, significant alpha of over 3% per annum added to our strategy. What's exciting is that when Hannah starts talking about drawdown and participation in both upside markets and markets that are down at any particular monthly interval, then what we do find is during a period of severe dislocations that the strategy performs quite well. High quality businesses often are sought after during periods of stress. Now, cycles never play out quite the same way, and high quality companies are already quite highly valued, and that is why we've been making sure that if the cycle does repeat itself, and we might face a recession the next year and a half or 2 years, or certainly a slowdown in world economic growth, our companies certainly the textbook would tell you that they tend to hold up better than the market itself, but at the end of the day, the future is uncertain. But that has been in our experience again a year ago when the market had that severe pullback in the September to December timeframe. We only had 64% of the downside of the market, so that was really encouraging for us. And I was just going to take you through some of those downside numbers analysis that she did on page number 15.
So we've got a selection of different peer group funds. Some of them are more similar to us, GARP approach funds, and some of them have a more slightly value skew. We just wanted to give you an idea. Our investors often ask us for a range of peer group numbers. And so like Peter said, the types of quality companies that we invest in with those stable earnings profiles often give us better drawdown statistics when we look at the portfolio. And since inception of the portfolio, like Peter said, we've only captured 64% of the downside in the market, but 103% of the upside, which translates, when you look at this, to drawdown numbers that are superior of both the market and the peer group as a whole. And what is also very pleasing to see is if you turn to the next slide, when you look at the volatility of the fund over 1, 3, and 5 years annualized, it's also lower volatility than the market and also our peer group, but whilst having a total return number that is far higher over a 5-year period.
Okay, let's just go into a bit more detail of the portfolio itself. So on slide number 19, we have for you some of the top positions in the fund. Alphabet, actually one of our stronger performers this month. Its Not an easy business to analyze, but it is interesting that we have a YouTube conference running. It's the first time I've been doing it. It is, of course, a very valuable asset that's owned by Alphabet, and conservative estimates of $120 billion that YouTube's worth. That's a business they bought for only $2 billion close to 7 or 8 years ago. And a fantastic example of how the world is changing. Digital advertising, both our names in Facebook and Alphabet dominate that market with 66% market share, and it's growing at roughly $50 billion a year. You compare that to some of the slower growth businesses in the traditional media space, and we just believe that as value investors, we want to capture the growth profile of companies like Alphabet and Facebook. That gives us a growth dynamic that's very hard to find elsewhere in the wider universe. And we back up those big growth businesses with companies like Reckitt Benckiser or RB Group, as they've been known recently. And it's very interesting how that company used to be at a very high valuation level before, when they were executing a lot better. They have cleaned up their business with a new CEO also due to arrive quite soon. I think he was an executive at PepsiCo before. So with some fresh blood coming in, it's interesting just over the last week or so that the stock is up 7 or 8%, not sure why, but from our point of view, that 5.5% free cash flow yield is attractive versus its own sort of 5-year history. And we just have to see if they can execute better in areas like their over-the-counter healthcare division, which really had some bad numbers in the first quarter. But their long-term growth profile in areas like infant nutrition, as well as their health and hygiene division, keeps us engaged with that stock. Along with names like Johnson & Johnson, that after about 3 years or so is back as a top 10. You saw some of the recent news flow on healthcare, with the Democrats again gaining a lead perhaps on the polls versus the conservatives in America. But so that the news flow perhaps on some of those healthcare names will be more adverse than the last 6 months or 1 year. But a business like Johnson & Johnson, having listened to them and having listened to the CEO in May in New York, we still feel that 7 to 9% growth profile long term at a 6 or 7% free cash flow yield will give us that sort of 6 to 8% return forecast that we have for the fund over the medium to long term. And of course, forecasts are fraught with danger, but from our perspective, given that our valuations, which we'll go through on average, is very attractive versus our own historic valuation levels, we still think earnings growth will determine return expectations for investors. And these top 10s traded on average at about 16 times earnings, with a very active return on equities, exceptional balance sheets, and on average 7 to 9% earnings growth, which will hopefully be the return expectation for currently investing in this fund as well.
So our next slide is just looking at our sector positioning, and I won't say too much about it because at the end of the day we are bottom-up stock pickers, and so all of our positioning is based around our bottom-up stock selection. But through the nature of our quality criteria that we insist our companies embody, there are large parts of the market that we will end up not investing in. We are completely benchmark agnostic, and we're not index huggers. And like we said earlier, we're looking for companies with strong balance sheets, low leverage, low capital expenditure. So large parts of the market we end up avoiding, such as financials. We won't some mining companies and so forth. We won't end up investing in. So if you have a look, we do actually have some large overweights compared to the market in areas like information technology and consumer staples companies.
Okay, and attribution-wise as well, Hannah does all the analysis for us around our attribution. What's encouraging is if you look at some of our top contributors to performance over the last year, it does include a selection of companies that are both new. So Facebook was a new position for us. It was as high as 50%. We trimmed the position at $203 with an intrinsic value of $210. So at the current level of $180, we might start to increase that position size again. But it also includes names like Yum China, which have returned for us, from our perspective, 53%, because it was actually quite volatile, in a volatile range. But a company, as we've said before, we've followed for over a decade and has been invested in for over a decade. and a very good dynamic business in Yum China, quite predictable with 7,000 to 10,000 stores that will be opened in wider Asia over the next 5 to 10 years, and a very clear growth strategy. But the only problem for us is today is just slightly above intrinsic value, so we're waiting for an opportunity to invest back into that name. But 33% performance for the fund this year. On the other sort of portfolio dynamics, Allergan, a good example of a business that we'll just cover very briefly later on the presentation. Not loved by Wall Street over the course of the last year or two. Got to a level, very attractive level, almost double-digit free cash flow yields. The governance issues around Allergan dominated the short-term headlines, with Brett Saunders, the CEO, also being the chairman. And the market got very despondent and knocked the stock back all the way to $130, where at that point it was bid for by AbbVie. AbbVie is a company also on our universe watch list, and a company that we might well end up investing in as well, because they're part of the offer that they made, which translates into an offer of about $118 for each Allergan shareholder, meant that the stock went up quite a bit. But if we do get some shares as part payment for our Allergan position, we might actually increase our position in AbbVie. We think the combined business have a very interesting growth dynamic, and the product concentration that we saw in both Allergan and AbbVie pre the deal is now in some ways more balanced, at 20% product exposure for Humira in the case of AbbVie, and 20% Botox exposure. And our analyst there, Shiraz, has done a lot of detailed work to have a base case and a bear case scenario. And even in our bear case scenario, we still think it's going to be a compelling stock to own for the long term.
So the next slide of the presentation is looking at our revenue exposure in the fund. And like I said, we have a global universe, and we don't actually give too much thought about where a company is listed, but what we want to know is where its revenue comes from. And so the two pie charts here in the presentation are looking at the portfolio both back in 2014 and this year. And when we look at the breakdown of revenues within the portfolio, we can see around a 30% emerging market exposure on a revenue basis. And this is through companies such as Yum China, for example, which is KFC China, which is listed in the US, but 100% of its revenues are generated in China. And then if you look at a company like Philip Morris, who have a similar story there. And what I also find really interesting when I'm looking at these things back across time is not only what our exposures are, but also how we access them. So on the flip side, where you've got companies like Yum China that are listed in the US, when we look back in 2014, we were accessing our emerging market exposure on a revenue basis quite differently through companies like LVMH, ABI, InBev that have that exposure over in the emerging markets. But now we have companies like Tencent that are listed in emerging markets, get their revenues from emerging markets. Samsung is another example of that. But if we flip the slide again, then we can see examples of three consumer staples companies. So I think it's Diageo, Reckitt Benckiser, and Danone, Unilever, sorry. And so Unilever listed in the UK, we've got Reckitt Benckiser, and these companies, so they're listed, you know where they're listed, but then if you look at their emerging markets exposure, it's over 50%. Emerging markets. So that's just an example of another way that we're accessing that within the portfolio.
Yes, so we ultimately, when you're looking at Reckitt and it's UK listed, you really are buying into an emerging market consumer dynamic, and that's where we think you want to be positioned. So on the contrary, if we look at emerging markets, it is dominated, the vast majority of that exposure is through inferior businesses. We would, for instance, in an extreme example, not be interested in Chinese banks. They are, at face value cheap at half times book, but there's a lot of bad debt hiding. Would we ever want to invest in financials? Perhaps an area like India is more interesting, where we think the capital allocation discipline and the dynamics of that economy is over time a more interesting risk profile than perhaps the Chinese dynamics at this stage. On slide number 25, we just want to take you through some of our examples of the type of businesses that we invest in. Medtronic is the world's biggest medical equipment company. It's been a top 5 position for us for possibly the last 2 years. It has been going sideways in a range of $70 to $90 for quite some time, and it's very interesting how the stock's broken out to the upside a couple of weeks ago, very encouraging for us. And our thesis is really played out with very sort of consistent execution of the strategy at about 3 to 5% organic growth profile, give and take quarterly fluctuations. And they are very well positioned in the 4 main categories of medical equipment. Clearly, for some areas like their traditional orthopedics business, that'll be a slower growth area than their transaortic valve replacement bits of their business. And I think the market is getting a little bit more excited with some of the robotics division applications coming on stream in the short term. And so now that some of the good news is getting more discounted, we finally started to trim the position at $110. So William has had extensive correspondence and interaction with that company. As you'd expect, it's a $60 million position for us across our investor base. And from our perspective, it's all about investing in a stable company like that. When they're a little bit out of favor, they were seen as slower growth than the likes of Edward Life, Stryker Corporation, and Becton Dickinson, but that valuation gap is now closed, and that's what valuation and value investing is all about for us. We also have in the next 2 slides just a brief comment on Allergan and Bayer Corporation. They are good examples of businesses that have clearly higher business risk than a business like Visa or MasterCard or Microsoft, which certainly don't feature as a top 10 position for us in the fund, but we still own 2 of those 3 names. And instead, with Bayer being covered by Shiraz on our team, and where I spent quite a bit of time also discussing with him the implied litigation risk that's in the current share price. So the stock that went as low as 50 euros early in the year, there are signs that they will settle the ongoing litigation issue around Roundup. They ended up with this Roundup liability through the acquisition of Monsanto. And from our perspective, we thought there's just a lot of bad news priced into the stock. If you look at the company and you stand back and forget about the litigation risk for a moment, you actually end up with a company now post their sale of their healthcare division of an over-the-counter healthcare side of their business, which is slow growth but stable cash flows, and then a sort of 3 to 5% revenue grower in the crop science business, which includes the Monsanto business now as well. And that to us is a very interesting and over time structural growth business, which is well positioned. They are the biggest in the world now, and from our perspective, an 8 to 9% free cash flow yield remains attractive for business that can grow earnings over the long term at 7 to 9%. So again, that's how we arrive at some of our return expectations. Clearly, on a monthly, 6-monthly, annual basis, we don't know how those returns will play out. But as value investors, we believe now is the right time to be investing in a company like that. I have spoken about Allergan, so I'm not going to cover that. Just to re-emphasize that with the AbbVie bit that came through, that's worked out very well in our favor, and we might well end up with an enlarged position in the new enlarged business, which will be a combination of AbbVie and Allergan. On Intercontinental, it has been a recent position for us. You may ask the question, if you look at some of the economic indicators in the world, some of those ISM numbers have come through. We all know that we're facing a recession. In a recession, you'd expect perhaps myself and Hannah to travel a bit less, depending on how our investor base grow over time and how many companies we need to see. But clearly, there is a risk that the travel industry will be one of the first industries that will be hit and not going to be in an economic slowdown. And slide number 29 just shows you that the valuation for Intercontinental relative to its own historic range is now attractive. So we just feel that a lot of those risks are being incorporated in the current valuation, and that's why we have started to build a position. We have exposure to the travel industry also through names like Bookings Holdings, covered by my colleague Louis. That is a structural growth area for us in the online travel agency space, and from our perspective, a 6% free cash flow yield, very interesting for bookings as well. Not that dissimilar to Intercontinental on a 1 or 2 year basis. And we have no problem owning both an online player in that industry as well as a traditional hotel operator, given that the dynamics are very similar with high returns on capital, very strong balance sheets, a lot of excess free cash flow. In the case of both Intercontinental, they tend to pay special dividends, which they have done over the last 10 years 2 or 3 times. And in the case of Bookings Holdings, they have announced a stock buyback which will retire up to 1/3 of their issued share capital. That's really for us a good sign of the management that believes that that stock is undervalued, and of course they have the cash resources to do just that. To summarize on Intercontinental, a capital-light business trading over the next 5 years, an average free cash flow yield of 6.5%. If in a couple of years from now, the historic 5% free cash flow yield is what investors would be willing to pay at that stage, the stock could be a big performer for us, but clearly in the short term, we will have to monitor results and just see if they continue to execute their growth strategy in Asia, which will continue to be a big area of growth for them. Clearly very well established already in developed markets, but Asia is where all the growth is going to be. And another good example of how we're trying to access that Asian growth dynamic through well-established businesses like Intercontinental. On the market outlook, I would just summarize on page number 33 this dynamic that about 30 years ago, the influence and the importance for areas like Europe and the US, those were much more important than what is the case today. If you look at developing Asia, full 34% of incremental growth in world economies is coming from Asia. We have investors all over the world, including some large institutional investors in Australia, and it's important for us to travel there to meet with both our investors and also see at some of the growth dynamics going on in an area like that, and how our companies use the Asian growth opportunity to also invest in markets within Asia. So for us, it's important that, as I have highlighted earlier, with an exposure of up to 1/3 in emerging markets, we do get that access through our companies that are mostly listed in developed markets. But the sort of slow terminal decline of areas like Europe will probably remain a factor going forward. And if you compare Europe, 30 years ago, they were up to 30% of world incremental growth. Today, it's only down to 16%, and that is a dynamic that we will capture to the extent that we will probably not end up ever investing in a domestic European business. So needless to say, European sort of energy companies that have not featured on our universe for quite some time. And it's been a terrific tailwind for us from a relative performance point of view. The future is murky. We don't know how that will work out, but if we focus and continue to focus on those areas of growth that is structural in nature, hopefully we will continue to outperform the market significantly over time. I'm just going to let Hannah talk you through the valuation of the portfolio today, because I think that's the important thing for you as investors. We very old school and realistic in our assessment of what investors can expect going forward. If you look at that 11-year track record, you can see over 11 years the market did 5.3% compound. We did 8.2%. The question therefore arises, how do we expect and how do we think the future will work out? And I think Hannah's going to take you through how we look at valuation and our dynamics of the portfolio at the moment on slide 34.
I think just an important thing to say is it's really pleasing if you look back over the past 5 years that we've managed to maintain our valuation discipline. If you look at our forward P of just over 15 times, then it's stayed around the average across the period of the portfolio, whilst capturing that growth in the market. And then also if we look at the return on equity of 25%, that's again it's in the region of where we've had previously. Now it's come down a bit. Maybe Peter, you want to explain that? But
yeah, I think through active management, clearly if you've returned close to 65% total return in US dollar terms versus 40% for the market over the 5.5 years, clearly that earnings growth wasn't 60%. So in other words, if we just kept the portfolio stale without doing any active overlays, you'd be sitting with a much more expensive portfolio today. So having sold over the course of the last few years, names like we've highlighted, Nestle, Intertech, Moody's Corporation, invested and disinvested and reinvested in names like Yum China, we do the analysis, and Hannah does full analysis on whether we add value on our active overlay. We calculate over 11 years, we've added close to 1,000 basis points or 10% with our active overlay. And I think it's in a world where momentum investing into quality stocks could be dangerous. And we've put out a piece on that recently, where we just try and highlight how we're moving away from areas of overvaluation and into more perhaps businesses with a little bit more business risk, but where we feel that the valuations are very attractive, and now is the right time to make that transition.
I think there's we see a big trend, particularly in some of our peers, other global funds, is at the moment is a kind of growth at any price portfolio, and so we're really pleased. I think it's actually one of the biggest competitive edges in terms of what we do here is that we will always maintain our valuation discipline, and we've got a free cash flow yield of 5.8% on the portfolio now, which we feel is very pleasing. We won't buy and hold our companies at any price, and I think also we have to just remember that we've got that long-term time horizon. We won't get focused on one-year trends. We won't go, if financials are rallying, we won't go avoiding our investment philosophy and piling into them, because that's what the current trend is. And I think that shows through our 11-year track record as well, that we've managed to stay the course. We've stuck to our valuation discipline, as you can see on that graph, and we've managed to look out over the long term and perform well for our investors. So
yeah, thank
no,
you.
The last thing I'll just sorry, talking over you there, Peter. We'll talk through. I'll just talk through our team very quickly. We're based in London. Peter formed the team back in 2012 when he joined with appointed our colleague William, which is our senior equity analyst, and then the rest of us subsequently followed. And we're a tight-knit team. We've got our global high quality team on the left-hand side of the chart you can see there, highlighted in blue. We're 100% dedicated to our strategy. But then Peter, as the head of global equities across Sanlam UK, also has access to the other research analysts within the firm, operating on a value side and a UK equity side as well. Now, he is 100% only managing our global high quality strategy, but what that also means is when we have these other research capabilities within the firm, Peter can draw on that analysis when he needs to. So an example would be an overlap with the UK team where the analyst and fund manager, Andrew, was looking into continental hotels, and Peter was able to draw on that. So it's a really well-supported research effort. We have our dedicated team. We sit together with a continued ethos of debate and discussion, and we work very closely together. And then more widely by the firm, we're very well supported, both operations, investment risk, and so forth. And then we have our fantastic local teams as well, who I understand you know very well and we enjoy working closely with. So I think that's it from us, but we have capability to take any questions that you may want to send in. So please do let us know if there's anything you'd like to ask us. Thank you very much for your time.
Thank you. I don't think there are any questions at this stage. Well, thank you very much again for your time. Just as Hannah emphasized in that last bit that you went through, Sanlam's very committed to the UK. We've built a research team in the global equity side with a lot of scale, with 9 research analysts now supporting the 6 people on our team for the high quality strategy. We are engaged with our investors all over the world. We think as participants in Africa, we think that is a big opportunity. We went on a recent roadshow with Ian Kirk, and it's encouraging to see that Sanlam has embraced the African opportunity. And clearly, if you ever need to get any information, then the Mauritius team is here to support you in that regard. And our doors are always open in London. We have a fantastic office in Monuments, close to Monument Station, and we would like to see most of you, if not all of you, if you ever get a chance to come to London to meet the rest of our team.
If you have any questions following this as well, I believe you're all in contact with my colleague Mary, so please do email them through and we'll come back to you as soon as possible. Thank you.